The first half of 2020 is, to say the very least, an eventful one. Contending with the pandemic that we have not seen in our lifetime, businesses are forced to evolve at a faster pace, while the society had to change their way of living, possibly permanently. Yet, despite COVID-19, the financial market's performance over the first 6 months of the year has surprised investors. In fixed income, falling government bond yields driven lower by aggressive easing of global monetary policy through rate cuts and quantitative easing have played a major role in driving its recovery. While fundamentals are challenging, monetary easing has driven asset prices back to pre-COVID levels. For the second half of 2020, we expect global fiscal and monetary support to be accommodative, with developed economies remain focused on providing fiscal spending and financial market liquidity support. On a fundamental level, it will continue to be challenging for economies around the globe, given the impact from the slowdown in business activities that is likely to drag global growth to its first decline in roughly a decade. With the US and the Latin America region still struggling to contain infection rates, we do expect subpar growth to be balanced out by the stronger showing in Asia, where large economies such as China is already seeing its GDP rebounding from first quarter of 2020. Despite the fundamental drags, technical readings, on the other hand, are much more sanguine due to the excess liquidity created by major global central banks' QE bond buying intervention. And with the rally that is driven by technicals since April 2020, valuations for local currency government bond yields have recovered to pre-COVID levels and trading at all-time low. We continue to see strong central bank support in the remaining parts of the year in support of the higher government bond issuances to finance deficits. Now, understandably, global economies continue to be constrained by the effects of COVID-19, and governments are likely to extend support should growth falters further. Interest rates around the world would likely remain at all-time lows, with several major economies having voiced their intention to keep rate easing option as a secondary tool in favor of fiscal and QE policy. Given this, we favor a more credit-balanced approach to our portfolio structure, looking greater into selective credit names to generate returns. Over in the local bond market scene, ringgit fixed income continues to be carried by investors' expectations of further interest rate cuts, with BNM already reducing its interest rates to an historical low of 1.75%. Inflation expectations are also expected to have bottomed, given the partial recovery in oil prices. We continue to believe in positioning into selected corporate bonds, given that they are cheaper in comparison to government bonds, which have appreciated significantly. Now, similar to Malaysia, our fixed income in Thailand strategy is a balanced approach between credit and government bonds. We have our duration strategy slightly longer than neutral, and we see corporate spreads to be key return generator in the longer run. For Indonesia, we are extending our duration marginally due to more attractive real yields. As for Asia, we remain constructive on the back of gradually reopening region. While business activities are expected to build up, the pace of reopening will have a bearing on how quickly Asia's recovery will be. As for today, the investment-grade space has already returned more than 4% in USD year-to-date terms, while high-yield bonds are still in the negative territory as a whole. So, with economic recovery chugs along slowly for 2020 and 2021, we believe that there will be selective opportunities in the high-yield space to play catch-up.